Good morning, ladies and gents. Welcome to the LAT Mentor Trade Review. We're going to have a look at CAD yen today. It's a good opportunity to do a relatively detailed trade review. It is a historical example, so we're going to work right the way through from initial concept, from market profiles and volume profiles, through to execution, where we can ultimately place entries, stops, and targets. It's going to give us an opportunity to look at both primary and secondary forms of analysis, and hopefully provide as a useful reference point for all of yourselves to have a look at this kind of setups. Not only you could be looking for, but we sort of make our bread and butter day in, day out here at the London Academy of Trading. So let's kick things off with the volume and market profiles. And first and foremost, we'll start with the shape of these profiles. On the right-hand side in volume profile, we've got a thin day. We can see there's no real clear acceptance of price at any one given level. And therefore, on a day like that, we have two options really. One will be a second day trend and continuation move to the downside, or alternatively, we can trade back through that thin day in an attempt to try and establish where was or where could fair value be within this price range from the 107.65 down to the 106.55 area. Now, the fact that the point of control has been left at the top suggests increases at least the probability that we're likely to trade back through that thin day rather than continue lower. From a market profile perspective, we have a P-shaped formation in here, which typically would be either a bullish continuation or in this instance, a bullish reversal formation. Also from the profiles, moving away from shapes, we've got this big significant ledge right the way up at the highs. Now just one TPO down from the high of the day, quite happy to treat that as a poor high and therefore a sign of positivity or potential positivity. And trading at the lows, we've got significant excess again. A sign of positivity that could come into the market. Looking back over a few historical profiles, we can see a similar scenario where I've got excess straight into a big ledge, so arguably poor highs on the 22nd, and then poor highs certainly on the 17th, 16th, and 15th, and out of those you've got the 15th and the 17th, those poor highs still yet to go on to be broken. Expectation would be to see that at some point down the road. So profiles here, market profile showing some signs of positivity, the volume profile with that shape also showing some signs of positivity. On the contrast, on the opposite side to that, showing signs of negativity, we have broken down through session lows on the 18th and 19th, quite a strong move lower. And we have also seen a value area start to shift lower from where we were trading on the 22nd. So there are some indications of negativity, but in an overall weighting, there's a lot more reason to believe this move potentially going to the top side. Supporting that from a fundamental perspective is since June and July, we've seen significant reductions in oil inventories. I think as we sit here today, we're around 34 million barrels under where the consensus should have placed us by now. And of course, they've also got Saudi and Russia cutting 1 million barrels per day. So there's plenty of rationale and reasoning for positivity in oil, which therefore reflects into the Canadian dollar. Huge positive correlation between oil and Canada, as Canada's largest export is oil. Of course, those Saudi and Russia cuts hadn't come in at the point of this trade, but the oil inventories data was still showing a very solid decline by that point. Now, just bringing in now our levels, and we'll start from the bottom and make our way up. This session low, so the previous volume profile low, the bottom line here, if we come back in time, also lines up nicely with a previous point of control and also a session low from the 9th of August. So multiple levels of confluence at that region. The next level up is then the start of the excess, quite often a well-respected support point. If we come back in time on that second level as well, that also lines up quite nicely with a little ledge here on the volume profile and the session high from the 7th of August. Continuing our way up, we've then got a low volume node. A low volume node from the previous day in line again with very close to session low and single prints. Okay, up towards the top, the two green lines here are these that are then our ledges, or for me, I'm going to treat these effectively as poor highs with just a single TPO above, a 2 TPO above. So that ledge or poor highs, however you want to look at it, always likely to be strong resistance. This one in particular at the top of the thin day also lines up very nicely with previous single prints and previous session lows from the 15th and 16th. The ledge up beyond that, not as many levels of confluence when you look back historically. However, can't be ignored. That falls in and around the 108 handle, which carries a level of significance. Hence why we'll keep that one in. Probably the strongest level of the lot sits up here. 3 session highs, significant poor highs just beyond that, and then the top of this little single print here at 108.20. So our market profile suggesting some opportunity for positivity. Our volume profile also suggesting a trade back through that thin day. Historical profile showing significant poor highs that could be broken. And now also with that, we've plotted our potential support and resistance levels. Let's just bring in the price action now. We can see where the current market is trading. So this was 7 o'clock in the morning, 7 a.m. So start of the European session. And we can see the market has traded back up through that thin day. And it's now found itself back above these lows, the lows of these days. Now we mentioned that was quite a negative a negative sentiment, the fact that this market had traded down through those lows. However, since then, we have traded back up, got ourselves back in above those lows, and now that opens up the sign again that we did not like trading down at these lower prices, didn't like trading down beneath that 107 handle. We're now trading up at 107.22, and that opens up then further upside. If we now hide those profiles and we just focus in on our primary analysis, and let's just dive into a slightly lower time frame, we can see how oil had started to establish itself in a really clear uptrend of higher highs and higher lows. We've also got a 3-touch trend line in there with a nice confirmed channel, and that channel showing us a good sign of momentum. The fact that the price reached the top of this channel indicates that this trend is still healthy, still strong, and likely therefore to continue higher. And that's of course in line with what we've seen from the profile analysis. We've got a Fib retracement in here, also reinforcing that level. So now we've got a confluence of a support from the profiles, a trend line, and a Fibonacci retracement. Okay, so Fibonacci retracement, the first of those secondary indicators reinforcing this potential support zone. I'm also going to bring in some pivot points in here. I've just got the daily pivot points, and we can see those orange lines running through here. Now this is the daily pivot. Okay, here is that daily pivot in here, and that sits just below the 61% retracement, below the support level, below the trend line. So numerous sort of reasons to suspect there to be some buying pressure within here, and from a stop loss perspective, a lot of defense before that position is going to be hit. So then comes execution. How are we going to look to get into this? Now, you've got a huge amount of confirmation at this point from market profile, from volume profile. So I think there's an opportunity to be relatively aggressive on this trade. Probably highest form of aggression, but still giving yourself some confirmation is waiting on a candlestick confirmation. Now, as we came down towards this level, we created a little hammer in here. Now, it's a 5-minute hammer. It's lacking any huge amount of power and oomph to it. So you might wait for a slightly higher time frame, came to a 15-minute time frame. Still, you end up with a hammer formation. So either way, signs of positivity coming in there. Now, if you wanted to gain a little bit of extra confirmation on that candle, we could also introduce another secondary indicator, and that would be our relative strength index. It's a momentum indicator. We would typically be looking for, if we're looking to be a buyer of this market, we would like to see that relative strength index trading below 30%, suggesting we're in an oversold region of the chart. And we can see here we have dipped down to around 25%, something like that. So significantly oversold. Now, confirmation on that oversold signal and a trigger to go long would be a cross back up and out of the oversold zone. So the immediate candle preceding that hammer we cross back up and out of below 30%. So that is now would be our confirmed entry. So you've now got hammer formation, oversold, crossed back out of oversold, and all of that has happened at the Fibonacci level, at the support level, at the trend line, and above the pivot point. Okay, huge levels of confirmation now at this point. Next choice then becomes your stop loss. Stop loss, most aggressive would be to place it simply below the candlestick and below the trend line. That's going to yield a very high risk to reward ratio, but you are leaving a few lines of defense behind. If you go marginally lower, you can take in the Fibonacci retracement, the trend line, and the support level, but the further you move the stop loss, the more you reduce your risk to reward ratio. If I come slightly lower again, here I can take into account the trend line, the fib, the support level, and the pivot point. Most definitely the safest stop loss, but of course the lowest risk to reward ratio. Most accurate or most realistic, most high probability target is simply just to target in towards the highs, previous high, and that would still yield a 1.45 to 1 risk to reward ratio or reward to risk ratio. So it's still a viable trade, greater than 1 to 1, so we're okay with that. However, there is possibility with this. The next resistance level is up here. Okay, that level we can see historically back through here. This is the ledge that we had previously seen on our profiles, clearly a strong primary level, and also sat just above that is the R1 pivot point. So there will be a reasonable amount of interest should we get up to there. Depending on the trajectory this trade takes, we may also reach up to that area of the chart as this channel as we interact also with the top of this channel. So I think T2 there looks pretty reasonable. That would be a 2.6 to 1. And if we were to take this considerably further, we also know that this green line up here was also a ledge, and the expectation would be for those ledges to go on to be broken. So there is possibility should you wish to try and take this further. However, we are now getting into the realms of a little bit more probably hope than probability. Risk reward ratios, of course, increasing significantly as we go. Now, in a trade like this, you have got huge levels of confirmation. Let's not forget that. The market profiles have shaped up very nicely. You've got a good blend of primary and secondary analysis. You've got a very safe stop loss. So you may wish on a trade like this to take a little and try and squeeze a little bit more out of this. But in order to do that, we can just manage our trade through. Okay, so as this trade progresses and as it develops, we can see the move away from that trend line. A little bit of hesitation. Okay, nothing too aggressive in there. Now we make our way up towards the high and up towards that first T1, and we see a little bit of selling pressure within there. Okay, and then ultimately we break. Now, from an in-trade management perspective here, we could look to trail behind the higher highs and higher lows. If we were to do that, we would have had a trailed stop loss up towards this low. Then we would have trailed a stop loss up towards this low, and then up towards this low. So we could have then managed it through that level and continued on taking that approach. That would have then meant a trailed stop loss up to here as we make our way through T2, and then this market would have pulled back and ultimately taken us out here. Now, clearly not then going on to reach T3, trailed stop loss would have taken us out back down here for around a 1.6 to 1, something like that. Had you just taken profits when you hit T2, you'd have taken 2.5 to 2.6 to 1, so you've cost yourself around 1%, allowing this market to pull back. But for some of you, that's going to be an acceptable risk because you could have opened up the opportunity for this bigger move up through here. The challenge with this bigger move is you're going to be taking that trade then probably through multiple sessions, and the number of variables and risks start to increase as the longer and longer you decide to sit in that position. Now, ultimately, this market does continue to go and break those highs, but it's a very different trade at that point in time. We're now trading into different days, different fundamentals, different technicals, and therefore, I think for me this third target was probably just a little bit too ambitious. We should have been in and out within the day, which this trade would have done. This trade overall from pulling the trigger would have been around 8 in the morning on Thursday. Would have been out at about 2 p.m. on Thursday. The nice thing with that is it also gets you out ahead of the open of the US session, which can always create a little bit of volatility and uncertainty. Okay, so there's a little bit of a review, a bit of a breakdown there of a potential trade that presented itself in the Canadian dollar against the Japanese yen. It's a combination of market profile, volume profile, primary support and resistance, primary trends, trend lines, Fibonacci, pivot points, and then ultimately a little bit of relatively simple trade management in there to try and manage this level, manage this trade through to some targets. All right, I hope you found that useful. Please do stay tuned for another trade review of us somewhere further down the road. That's all from me for now, team. Good luck with your trading. We'll catch up with you all soon.